Welcome everyone to the final act of the second Future of Financial Information conference. And while everyone's joining, let me start by introducing our speaker. So Lily Fang holds the AXA Chair in Financial Market Risk at INSEAD. And together with her colleague, Joel Perez, who was actually also at this conference, she did important work on the role of media coverage in explaining the cross-section of stock returns. So that won her the Smith-Breeden Prize for Best Paper in the Journal of Finance in 2009, I believe it was. Also a big personal influence is that I read that paper in my first year of PhD, and look where I ended up, organizing a conference about financial information. And more recently, she's also done work or is doing work on passive investing and what that means to information and risk in financial markets, which actually brings us to the topic of today's keynote. It's just one word about the format. So it's webinar format, which means that as an attendee, you can submit questions through the Q&A function, which you should see down in your meeting controls in Zoom. And you can also upvote questions asked by other people. And whenever I see a trending question during the talk, I will try to weave it in and let Lily respond. And regardless of that, we will also try to save some time at the end for a Q&A. So with that, a very warm welcome to Lily Fang, and please, the screen is yours.
Great, thank you, Michal. Good afternoon, everyone. Good morning to some of you, maybe in different time zones, or good evening for those of you in Europe. So first of all, I want to thank Michal for inviting me to speak at this really excellent conference. I really enjoyed in the last few days a number of papers and the discussions. And I also want to thank you for organizing this, I think on behalf of all the participants so far in this conference, because it really provided us to feel some normality in a time when everything is but normal. And so this is highly appreciated. I was really looking forward to coming to beautiful Stockholm, this summer today. In fact, which I haven't visited, had the opportunity to visit. So I hope that we will have a physical opportunity the next year, next time when this conference is run. I think you definitely should continue this great momentum. So the topic of my talk today is going to be about passive investing, which is index investing and ETFs, which is the strongest investment trend in the last decade. And also market risk, which I mean aggregate level market volatility. And the main point of my talk today is about, we know that passive investing has been rightly billed as the most efficient way for investors to get a diversified exposure to the market return. But perhaps there's a possibility that it could be too much of a good thing, in the sense that when you have a very high extent of index investing, it might not only be related to, but in fact contribute to a higher aggregate level of volatility and market risk. So in some sense, the diversification power of holding passive investment might be self-limiting. That's why the first part of the title, the limits of diversification. So let me start by just showing some data, which I think some of you, maybe most of you are actually familiar with. So this first chart shows you can see this chart looks almost like a mirror image. It's the last 5 years of fund flows into or out of different types of funds. So you see the blue bar, that's the flow into passive funds in the Morningstar mutual fund universe. And the opposite of that, the orange bars, is the flow out of active funds. So those two things almost are like a mirror image, which just tells us that in the last 5 years, there has been a strong inflow into passive funds and at the expense of outflow out of active funds. And the two almost sort of exactly cancel each other out. Now, this has been going on for a long time. In fact, if you then, cumulate this effect over a period of time, this is what you see here in this chart. It shows the percentage of active versus passive investment in the Morningstar domestic equity mutual fund universe. And the two series obviously add up to 100%. So for dramatic effect, I'm showing you literally this mirror image. And you can see that consistently, in the last couple of decades, there has been a very steady increase in passive investing at the expense of active investing, which corroborates the earlier evidence I just shown. And there was a milestone that was reached in August of last year. In August of 2019, for the very first time, the passive mutual funds in the Morningstar universe has exceeded the total assets under management, has exceeded the active fund for the first time. And I think that this is a moment of no return, in the sense that this trend seems to be all but gathering force. So I think to our academics, perhaps this is not surprising because, I think that we have been schooled in the theories of market efficiency and the ideas behind doing passive investing. We might be surprised that, in fact, I do quite a lot of executive teaching, I was almost a little bit surprised when I talk about executives that this notion is new to them, actually. But I think for academics, this is a very well accepted notion because the ideas behind this are well supported both theoretically in terms of Nobel Prize winning ideas, market efficiency, and also just decades of empirical evidence that essentially shows that the superior performance, especially net of fees, coming from passive investing. So to us, maybe this is already a very well accepted notion, but I just want to pause here for a moment and really think about, why is this, a big deal? I think that this is a really big deal because if you think about it, passive investing is basically a better and also cheaper way of investing for many people. In fact, for all the average investors, which probably consists all of us. And so that's important because this means that, you have a technology that has a potential that has, a disruptive power because it does something better and cheaper, which you don't necessarily always have that combination of better and cheaper. So in terms of better, we all know these numbers, right? So every year, almost more than half the actively managed mutual funds underperform their benchmarks. And in recent years, the number has been more than 70%, and cheaper in terms of much lower fees. And by the estimation of this Bloomberg intelligence analyst, he's estimated in the last 3 decades, essentially investors collectively have saved about $1 trillion in terms of management fees alone. So you can see that this is truly a disruptive technology in the financial industry. And I want to just kind of push this a little bit, further. I would like to say that because passive investing is both better and cheaper, and because of its massive adoption by the investors and this non-stoppable trend of movement towards passive investing, I want to say that, the pioneer of index investing, which is John Bogle, he was the founder of Vanguard and the creator of the first index fund, S&P 500 index fund. He's basically, the Elon Musk of financial market, right? Because, perhaps save the crazy communication style that Elon quite often exhibits. But what he has done is no less disruptive for his industry, which is investment, versus Elon Musk in terms of electric vehicles and how we transport and consume energy. In the sense that they have disrupted a market and brought something that's technologically superior and achieves better results, and even it's cheaper. So, but with this sort of disruptive success behind us, now it looks like it's a foregone conclusion. It's actually easy to forget that just like Elon Musk being a disruptor for the car industry, John Bogle being the disruptor of the financial industry, I think innovators and disruptors tend to be ridiculed in the very beginning. So there was a lot of skepticism about what he was trying to do in the 70s. So when he first launched the S&P 500 index fund in Vanguard, it was actually called the First Index Investment Trust. And so that was launched in August of 1976. The target was to raise 250 million, but he only managed to raise 11 million, despite the hard work of 4 leading underwriters. And so this is undershooting the target by 95%. And the idea was essentially for the next 10 years was called Bogle's folly. Essentially, this is a crazy idea. This is a crazy guy. This, by the way, actually reminds me of the analogy or the story, the video that Michal first showed on the opening speech. You're talking about there in the beginning, there was one crazy guy dancing, right? And then there was a 2, and then there's a crowd, and finally there's a movement. So, combine this inauspicious opening at the beginning until, what we have seen in the last decade, I think that this is an example of that same kind of movement. And also, just to remind you, at that time, Fidelity was at its heights, and the head of Fidelity said, I can't believe that investors are simply going to be satisfied with the average returns. The name of the game is to be the best, right? So this just shows you how things has changed. The rest, of course, is history. Today, the Vanguard 500 index fund alone has an asset under management of $500 billion. And so if you compare that to the $11 million at the very beginning, this is a compounded annual growth rate of 27%. I think very few things, perhaps save some of the investment record of Warren Buffett, maybe come close to this number. So, the battle has been won, and the passive has won, and the actives are on the losing end. End of the story, right? So the question is, of course, has the debate really been settled? What can we say about this? So to make it just kind of fun and interesting, I like to share a little bit of ask you, in fact, this is of course a rhetorical question, whether the debate has been settled, but I like to ask you a real investment problem, okay? I like to ask you the investment problem faced by a very prominent economist. So Paul Samuelson, I hope that we're all familiar with. Paul Samuelson was the first American economist that won the Nobel Prize in 1970. He was, more than anybody, the founding father of modern finance and modern economics, in the sense of bringing rigorous mathematical analysis in economic studies. And so, in fact, some of the ideas of market efficiency and the theoretical underpinning of the strength of passive investing actually came from him. So in 1965, he wrote this article, he wrote this paper that the title, I need to say no more. You can see that this is the foundation of the ideas behind market efficiency. He wrote a paper called Proof That Properly Anticipated Prices Fluctuate Randomly. And in addition, in 1974, he wrote more of a sort of a popular article. It was published in the Journal of Portfolio Management. It's called Challenge to Judgment. And in that article, he wrote, "A respect for evidence compels me to incline toward the hypothesis that most portfolio managers should go out of business, take up plumbing, teach Greek, or help produce annual GMP by serving as corporate executives." Okay, so my question is, someone like Paul Samuelson, right? How would he invest? How, which kind of investment would he take? So Michal, would you be kind enough to launch the poll that we have?
Yes, it's live now, so all the attendees can see it and vote. And
I'm very curious.
Yeah.
So would he invest with S&P, the Vanguard S&P 500, or Warren Buffett? Neither or both? And no cheat, right? Like looking at internet, trying to find the answer.
Yes. Right. There's no time. We're gonna close the poll in like 30 seconds.
Okay.
We have 77% voted so far. So Yep. If you
just flip a coin, right? All right.
yeah, exactly.
Roll a dice.
All right. So the poll will end in 5, 4, 3, 2, 1. All right. So these are the
Oh
results.
wow. This is just a real-time test of market efficiency, right? we have the answer all over the place. So so that's great. So this is I love it. Okay, so thank you so much, Michal. So let me tell you, and this is the twists and turns in life, right? So it turns out that he actually he invested in both. Okay, the least number who voted for that, you are the winners of this, right? That's 21%, tied with neither. So he actually invested in both. And I will tell you that he actually invested in Warren Buffett before he invested in Vanguard 500, because Vanguard, remember, the S&P 500 fund was only launched in 1976. So Paul Samuelson, on the other hand, actually started investing in Berkshire Hathaway shares in 1970, the same year that he won the Nobel Prize, right? So I think that that's like doubly good news for him that year. He won the Nobel Prize that year, and he also just, kind of picked the right stock to invest for that year. So he actually had a little bit of an inside sort of, he had a tremendously good luck, because there was somebody who was working with Warren Buffett who was really believe in this value investing, actually showed up in front of his office and wouldn't leave until he saw the famous professor. And when he was waiting for Paul Samuelson to come out from the office, he actually talked with the receptionist and convinced the receptionist to buy Berkshire Hathaway shares. And finally, he had a chance to speak with Paul Samuelson, and Paul Samuelson realized that either, it's a con, or there's something real, and I should invest in the stock. And so I think that his belief of market efficiency is that it's very, very difficult to beat the market. But of course, such skill could exist, right, in a very selective sense. So he actually started investing in Berkshire Hathaway stock in 1970, and ultimately invested in the stock at an average price of $44 a share. So those of you who are familiar with Berkshire Hathaway, you know that the current stock price is trading at about 280,000 US dollars, give and take. And so in fact, he made a tremendous fortune by investing with Warren Buffett. And he, of course, when John Bogle was launching the S&P 500 index fund, Paul Samuelson, as you can see, his theoretical beliefs about the force for the superiority of this kind of index investing. He was a frequent and important advisor for John Bogle, and he was also early investor in John Bogle's fund. However, he by far made more fortune from the Berkshire Hathaway than the index fund. Okay, so this is just a little bit of. Yeah.
If I may, it actually makes me wonder. So, what was the incentive for that salesman to, spend half a day sitting outside Paul Samuelson's office?
That's a very good question. He probably just is, he just out of the goodness of heart, and he thought that this is a kind of at the forefront of economics. He really just wanted to challenge or say, look, market efficiency doesn't rule out, right, the existence of superior skills. And, maybe that's also intellectual sort of a challenge. So that's a very interesting question. But I think that, Paul Samuelson quickly decided that, this is not a con, it's actually something real here. So, which is, again, consistent with this belief that market efficiency means that on average it's very hard to beat the market, but you always have chances of finding superior skills, and when you do so, you hold on to it and you invest heavily in that. Okay, so that's just a bit of historical anecdote to tell us that we shouldn't be so doctrinaire about any sort of theoretical prediction, because we should look at the facts and we should look at the evidence. Which is just to say that we should evaluate this idea of indexing a bit more. And on that note, I did something. I want to show you some rather unscientific evidence that, in my view, suggests that there needs to be more research done on the whole thing of indexing passive investing, which I'm currently working on. So I did a very quick search in SSRN in the econ and finance literature on articles that contain certain keywords in the title or the abstract. And so I was trying to compare, how many papers have been written on passive investing and indexing ETFs versus, some other sort of financial disruptive technology recently, such as fintech or Bitcoin, blockchains, cryptocurrency, and so forth. So my very, very simple unscientific method yields, at least, shows that there's actually more paper on the Bitcoin and blockchain versus index and passive investing. And to me, this is a little bit surprising, actually, because, in my view, index fund and passive investing is really the most disruptive and relevant technological innovation and disruption in the last century. It affected far more people and perhaps saved the economy far more resources and delivered much more wider benefits to society than so far, at least we can say, about blockchain and Bitcoin. It's been also existing for much longer. So my sort of conclusion from this is that a lot more research need to be done about passive investing and indexing. And especially we've come across this milestone in history that passive is on the verge of overtaking actives, at least in the US domestic mutual fund space. That's already surpassed, even though in some other fund universe, maybe that's still lagging, but we can see that it's gathering momentum, and the consequences of this movement needs to be more thoroughly investigated. To me, in terms of more research on this area, there are at least three, maybe there's even more. There's at least three types of questions I think that's not really 100% settled and calls for more investigation by academics on passive investing. The first is about how the rise of passive investing affects the information structure, which, information economics and information structure is the topic of this theme of this conference, and market efficiency. So, how does the rise of index funds affect the active managers' incentives to collect information, or analysts' incentive to collect information, the distribution of information that's available to different market participants and so forth. So I know that there has been quite a lot of work done, including some of them presented in this conference, but I think that still, this is a very much, there's still a lot of room to do more research in this regard. The second kind of question that regards passive investing, which I feel has a tremendous amount of growth potential, is the impact on corporate governance, right? So even though these investors are the passive funds they're passive in nature, it doesn't mean that they're actually passive in terms of corporate governance. We know that they control quite a lot of voting shares. And so what does that do to corporate governance, to the way that companies compete? We have recent paper in the Journal of Finance looking at competition among companies where you have common owners, and especially those owned by passive funds, such as BlackRock and State Street. So again, huge implications in terms of corporate governance that I believe should be looked at further in the academic literature. And so today I'm actually going to touch on a third element, which I think that perhaps has been also been less discussed, which is how the rise of passive investing and will affect the aggregate market volatility, and also specifically the correlation structure between securities in the economy. So what's the idea behind that? The hypothesis that we have, by we, I mean, this is ongoing work jointly done by myself and Hao Zhang at Michigan State, and Lu Jing at UC Irvine, and Zheng Sun at UC Irvine, with support of some excellent research assistants from University of Singapore, National University of Singapore. So our hypothesis for this is that as more assets are invested through passive index funds and ETFs, which tend to have a more tendency to trade securities as a basket, you would imagine that the correlations between the stocks will rise. And the next step, the next implication from that is because the aggregate market volatility is determined by the average covariance between stocks, it is possible that the higher incidence of indexing can lead to higher market overall volatility. And if that's true, then that gets back to my main topic, which is that the diversification power of doing passive investing can be self-limiting. The more you do, the more people who are doing passive investing might inadvertently lead to securities being traded in a basket, increasing correlations between them and increasing the market overall aggregate volatility. So we actually want to subject these ideas to empirical tests. And our starting point is the classical paper by John Campbell and others. And by the way, this paper, I was so pleased to see in the first paper of this afternoon session, I think was presented by Eliza Wu, right? She also mentioned this work. And so some of the patterns I will show for those of you who actually attended her presentation will know that it's completely consistent with what they find there as well. So if I may remind everybody what was the main finding and of the Campbell et al. 2001, essentially the main finding is that between 1962 and 1997, there's been a noticeable increase in firm level volatility relative to market volatility. And accordingly, correlations among individual stocks has gone down. And the explanatory power of the market model for the typical stock has declined. So we started from this paper because essentially it tells us that up to the mid-90s, the direction was going the opposite way from what we were thinking. So essentially you have idiosyncratic risks increasing, but market risks didn't increase. By implication, the correlation structure between stocks were decreasing. So we start from that by replicating the Campbell et al. 2001 paper. So these graphs, and the next few graphs I will show is the exact replication of their paper up to 1997. So this first graph just shows you visually that yes, indeed, market volatility goes up and down over time, but there's no discernible trend in terms of the market overall volatility going up in this time period. And the next graph I will show you is, again, another chart that Campbell et al. Has in their paper. It's about firm level volatility. So just as their paper, we show that you can see visually, you can see that there's almost a visual trend of upward trend in terms of firm volatility during this period from 1962 to 1997. It almost tripled over this period of time. So if you put those two together, market volatility didn't increase, firm volatility increased. The market volatility is the average covariance, so which the volatility goes into it, but the correlation is a very important part. It has to be the case that the correlation has gone down. So indeed, that's exactly what you see. And in this third chart, you can see that the correlation between stocks between 1962 and 1997 does seem to have a trend of, even just visually by casual empiricism, you can see that there's sort of this trending down. Okay, so then we take it from there and took the analysis forward by extending the study. What do we see in terms of when we add more recent years to the sample period? So what we have done is then, repeated the same exact analysis, but take it all the way to to the end of last year, 2019. So again, this is just somewhat casual empiricism. You can see this the orange dashed line tells us the divide between Campbell et al. Sample and the newer sample. you can see that there's a lot more higher volatility, market volatility periods over in the subsequent period after their paper sample ended. On the other hand, if you look at the firm level volatility, you can almost see there's again a sort of a regime change in the sense that there is a trending down in the sample that was subsequent to the sample that their original study had looked at. And so then if you put those two together, it may not be surprising to you. And this is in my view, this is a pretty dramatic picture. We do see earlier on, there was a sort of this trending down, and you can see how dramatically the market average pairwise volatility, correlation between stocks have increased ever since the end of the sample period that the original Campbell et al. Paper looked at. So this at least kind of indicates that, and you know, so where are we going with this? We're going with this in a sense that in this latter period, maybe a number of things contributing to the increase of overall correlation between stocks, but perhaps maybe at least one of them is something to do with indexing, because we know that the movement towards indexing really started to gather pace around the turn of the century. So of course, we want to.
If I may step in with a question from the audience, that passive trades are typically uninformed. So should their effect on markets volatility not only be like only short term in the short run? What?
Yeah, so I mean, so that's exactly, so that's a very interesting question. Indeed, these trades are uninformed, but when you have a basket trading, so our argument is that it increases the covariance, right? So in the back of our mind, in a sense, the mechanism is that there is essentially, selling pressure or buying pressure, essentially capital flows. And if you can trade stocks discriminantly, in a sense that selectively trade on active information, that does not increase the correlation so much. But if you're actually precisely because you're not trading on information, just because of capital flows, right? Because index funds and ETFs, they need to trade, they need to provide liquidity when the end users, investors are either putting money into the funds or withdrawing money from the funds. Then in some sense, by having to trade in the basket, you increase the correlation, and I don't necessarily think that that's a short-term effect.
Yeah. Okay, thank you.
So in a sense,
maybe sorry, this question just came in, and it's about trends. So maybe that's why it's good to ask it now. Yeah. So why do you think there's no trend after 2008, even though indexing did keep growing during this period?
Yeah, I mean, look, this is a little bit of a casual empiricism. I want to subject to, a little bit more rigorous testing because, again, these time series, there are many things that go into it rather than just one indexing, right? Could be many other things. So let me just then go on. This is a great point for me to mention a few potential hypotheses and try to test. I think that, when you are looking at these kind of series, there's too many things that can be co-moving at the same time. And so we're trying to tease out that perhaps one of the contributing factor could be the indexing issue, right? There can be many other things going on as well. So this is just a summary of the data. I'm not going to, in the interest of time, not going to go into that. It seems like things have changed, right, since the turn of the century, essentially. And which, by the way, kind of coincides with the timing of the increase of indexing. That by itself, of course, doesn't prove anything, but at least is some kind of a passes or supports information that is kind of going in it passes a smell test, right? It's going in the right direction over this period of time. So let me talk about potentially, so this is our key question of investigation, which is what can be driving the correlations higher over the last 20 years or so. So one thing clearly can be that the economy has fundamentally becoming more integrated through the supply chains, economic integration, maybe different regions are more integrated, different firms. And also don't forget the dominance of large firms. That's been sort of discussed in Gabet's paper. And as we know, in the technology industry, for example, there's dramatic, concentration and of large firms. So these could be part of what's going on fundamentally. So fundamentally, there's tighter economic integration across the firms that could drive the correlation in the stock prices. On the other hand, you also have this, which is higher institutional common ownership. So there was a great paper, in fact, this is one of our key references by Anton and Pock in the JF in 2014. They actually look at joint stock pair level joint ownership by active mutual fund. So in some sense, our idea here is very related to that, except that we just focus more on the passive part of it. So our perspective here is that then you also, at the same time, you have higher prevalence of index investing. So, and I have to just be absolutely clear that we're not claiming this is the only driver. This is not at all meant to be mutually exclusive vis-a-vis the other forces that could be driving this. But in terms of our focus, we are focused on this. So our empirical analysis is going to be focused on whether indexing has an effect on the overall market volatility.
So perhaps looking slightly ahead, there's a question whether you think that most of this effect would be coming during periods when funds have to rebalance due to additions, subtractions from index, for example.
That's a very interesting comment, and this is related to some of the identification results that we want to show. And indeed, as I mentioned earlier, the mechanism comes from funds flows, right? So, but we didn't actually use the index addition or subtraction as a test, because when you add to especially S&P 500, there's many things you can argue that fundamentally may be changing for the stocks as well. We really debated, and this is maybe a route that we would go, as you know, this is ongoing research. So that would in fact offer us a way of valid identification. For various reasons, we haven't gone there, but the idea is that we are going to look at specific period using a difference in difference approach. So essentially, we're going to look at some kind of, market disruption that using those as a difference in difference. So let me then, this is a great question, foreshadowing what I'm going to talk about, which is how do we empirically, kind of identify this effect. So the first is a very simple smell test, which is, do we see in the aggregate time series a relationship between the extent of indexing and the average pairwise correlation? Okay, this doesn't prove anything. It's just a simple smell test. The proper test, of course, is looking at variables in a more careful fashion. So the outcome variable that we want to focus on would be something that captures the stock's correlation with other stocks. So we look at beta, and we look at average correlation of a stock with all the other stocks in the market. We're also actually doing just pairwise correlation calculations, but those calculations are extremely time consuming. So today, the results I'm going to show you is mostly on stocks beta and its correlation with the other stocks. Main explanatory variable of interest is that for every stock, we construct a new measure that measures extent of index exposure of that particular stock. And so we will look at the relationship between the outcome variables and the main input variable. And in order to identify any sort of causal or contribution relationship, we want to use difference in differences. So let me show you what is the measure that we calculate. It's a fairly straightforward and intuitive measure. So every stock, every quarter, we basically calculate the percentage of that stock's market cap that is held in all the index funds that we can identify from the domestic mutual fund space. So for every stock, you basically calculate as a percentage, and this is updated every quarter. And for the pairwise analysis, we are also doing some analysis and looking at maybe the average index exposure of the two stocks in the pair. So with that main variable, okay, let me show you first of all, the evidence on the smell test. So this is a market level time series, and I'm not even showing you the regression here. This is just a plot between the blue line is the S&P index share, which is the amount of total S&P indexed assets in the mutual fund space divided by the total mutual fund domestic equity asset under management. So basically, this is to say how much money in the domestic equity mutual fund has been indexed to the S&P index. So by the way, this excludes other index assets. This just is it's only part of the index universe. And then the orange line is the average pairwise correlation over time. So clearly this doesn't go step by step, one by one, but there's a very high correlation of 48%. And if you run the time series regression, the regression coefficient is very, very high, 0.9, and with a t-stat of 9. So extremely significant. But of course, this doesn't prove anything. At least it offers us hope that maybe we're onto something. So let's next look at the more rigorous test. So if we then want to look at evidence from the stock level, right, you can imagine running a naive cross-sectional regression, which is basically the outcome variable is beta or average correlation with other stocks between stock I and the others, and then run it on this main independent variable of index exposure and some other controls. But of course, when you do a simple OLS or panel regression like that, there is no causality you can infer. You have to, I mean, you cannot even make claim that this coefficient is measuring specific contribution by this, because that index exposure could be measuring a whole bunch of other things that's co-moving with it. So therefore, in order to have a cleaner identification, we are looking at some kind of market dislocation events. And by the way, this is where, you know, just coming back to the earlier question, the reason we decided at this point not yet to use the index addition of a particular stock is because that's a very endogenous event for a particular stock, right? So stocks are added to the index for a reason. So therefore, we still feel it's not so clean. So we decided at this point to look at a market-wide event, market-wide dislocation, which would cause market gyration and index funds buying or selling in the aggregate. So because this market level event, we believe it's a little bit more exogenous to a shock to individual firms. And so the main test that we want to look at is, do firms with higher index exposure measure going into the event emerge with larger increases in their correlations with other stocks, or maybe larger increases in the betas. And I also want to emphasize that we don't necessarily expect that increase to also apply, or the difference in difference to also apply on the volatility. So this really is about correlation between stocks. And so then the market-wide shocks that we are looking at, and by the way, this idea was literally, this is fairly new. We were inspired by the recent market disruption. So then we went back in history and said, okay, which are the other major episodes of market dislocation that we can look at historically? So one is the 911 in 2001, and the other is the Lehman Brothers going bankrupt in September 2008. And we do want to use the recent COVID-19 March 2000 period as well, but you know, since the shutdown, we are not able to access data from data stream, you know, that has to be accessed from the library, but we can't wait. In a sense, I can't wait to actually put this to test as well. So we so far use these two earlier episodes to look at the events, to look at the effect that we're trying to capture. So the way we do this is to the standard difference approach. We sort stocks by their pre-event index exposure measure into quintiles. And then for each quintile, we look at the before-after difference in this stock's change in terms of its average correlation with the other stocks. And we also do this for betas. And then we compare the difference between high and low quintiles sorted by the index exposure measure. So that's the diff in diff. And so we expect, if our hypothesis is right, we expect bigger differences for the quintile that has a high exposure relative to the low quintile, the quintile with a low exposure. And I also emphasize that this we expect on the correlations, but not necessarily on the volatility. Right, so Let's look at the data. Let's look at the results. So I'm going to show you in terms of graphic form because it's easier perhaps to look at. I'll have the numbers, but maybe just go through them quickly later on. So the first chart here shows you just the results after 911, before after 911. So the blue bar is before and the orange bar is the after. And what I'm plotting here is for each quintile, I'm plotting the average correlation between the stock in that quintile and between that stock and the other stocks in the universe, not just the stocks in that particular quintile, but everything else in the CRISP sample. So you can see that in the before, the blue lines, there is a bit of an increase from the first quintile to second, but then pretty much it's flat after that. So the average correlation doesn't really line up very neatly with the index exposure measure. But then after the major event, after this dislocation, there is a very clear, kind of positive sorting effect, if you like, between that quintile measure of the index exposure and the correlation. This tells us that the increase in correlation with other stocks in the high quintile is exceeding that in the low quintile. So if I look at the beta, actually this is the beta chart. So you can see that actually for the before period, the beta doesn't actually line up in a monotonic fashion with the index sorting variable with the index exposure. But after that, there's a much clearer sort of lined up in terms of the direction. And last but not least, let me show you the results on the volatility side. This just shows you that this effect is much more about the correlations and it's not about the volatilities. And so, maybe that's why in the aggregate, when you look at beta, the trend is not as clear. But if you look at the decomposing that into correlation and the volatility, there are two different trends going on here. So here, actually, you can see that there is a declining, volatility for these stocks over this period of time. So we think that it's a pretty strong, evidence showing that there's maybe something to our hypothesis that this index exposure measure helps contribute to increase the correlation between a stock and the other stocks in the universe. So the next few slides are a little bit busy. I would just go through them quickly. They are just the numerical forms of what I've shown you, but not only for the 911 crisis, but also the other period. As you can see, the diff and diff is fairly significant in both periods for the correlation, as well as for the betas. That's also significant. But for the volatility, it's not. In fact, it is significant the other way. So this is really saying that that index exposure is really able to tell or kind of sort out the differences between changes in the correlation structure rather than the changes in the firm level volatilities. Okay, so this is just the simple difference in difference, and of course there's many refinements that we want to make. One is to adjust for industry returns because there might be common elements related to industry returns and also other type of characteristics-based adjustments and so forth. But the two refinements in the interest of time that I like to share with you today are the following. So one is a refinement, the other is sort of an extension actually. So the refinement I want to show you is that we want to control for this institutional holdings because after all, index holding is just one part of institutional holding. So is our measure just simply absorbing or picking up, cross-sectional differences in institutional holdings, including active mutual fund, rather than just indexing? So I want to get into that. The way we do that is by double sorting. So essentially controlling for these other institutional holdings. And also by multivariate regression. And we have other ways to, we want to look at correlations and earnings to control for the fundamentals, the correlation in fundamentals, and also looking at concentration of large firms. These are, I don't even have the results yet. They are running in the background. But the other thing I want to mention is the relationship between this measure and the cross-sectional return pattern, because the more we look at this, we realize that this index exposure is actually very much related to the common factors that we think about in asset pricing. How does it affect small firms versus large firms, growth versus value? and momentum stocks and so forth. So that will be the last result I'd like to share with you. So quickly, in terms of the regressions, when we put in the institutional ownership, as you can see, the institutional ownership variable is very important, but the interaction term, which is kind of post-event interacted with the index exposure measure, is highly, highly significant in our measures. And in terms of double sorting, this is maybe a more intuitive result in a sense that we double sort. So we do dependent sorts. So we sort firms first on just institutional holdings of all 13F institutions. And then we look at within a institutional holdings quintile, what happens to the different diff, once we further second sort by the index exposure. And if our result is able to survive that, which means within the quintile of institutional holdings, then that means that, at least, this is we're not identifying something that would be subsumed by this average or the overall institutional holding. So as you can see, the red numbers, they show that most of these are significant, except for the low institutional holding firms in the earlier period. And this could be that it's just a lot more noisier at that time, and also overall extent of indexing could be relatively weak. So overall, I think there is still reasonably strong evidence that controlling for institutional holdings, there seems to be this effect. And finally, last but not least, I want to show you this result, which is how this is related to the cross-sectional stock returns. So we do something, again, very simple. We sort stocks by the index exposure measure into quintiles, and we calculate a monthly long-short portfolio return, which is low index exposure minus the high. So in a sense, this is contrarian in index holdings. And we have monthly series of 1980 to December 2017. And we regress this on the existing factor models. And the results we find is the following. So the top panel here uses the equal weighted long-short portfolio, low minus high index exposure measure. And the bottom panel is the same, but evaluating the returns. So as you can see, we have the Farmer French 4-factor model and also the 6-factor model, including the investment and profitability factors. That's more recently becoming quite prevalent. And from all the big stars and the T-stats, you can see that these results are highly significant, meaning that this long-short portfolio return, in fact, we can also see from the coefficients, right? They are related to these factors in various different ways. And this is something that we really want to dig into, as soon as we get back to this research. And the constant means that there is a significant alpha here. And so just in terms of the magnitude, this number here means this is 40 basis points outperformance or alpha per month. And at the same time, this number means it's 1.3% per month. These are, I think, economically very significant numbers. And what's really interesting is that the value weighted returns, in fact, give you higher alphas, which, you have focused more on the large stocks, which I think is an interesting result, because typically asset pricing anomalies tend to be more pronounced for smaller stocks. Okay, so let me kind of, in the interest of time and hoping to have some discussions, just to offer some concluding words. This is ongoing work. And I think that in the past 40 years, indexing has been rightly recommended to average investors as the most efficient way to participate in the economic growth and value creation in the financial market. And after strong initial skepticism, investors wholeheartedly embraced this revolution, in a sense, kind of this new trend. And John C. Bogle, the pioneer who created the first index fund, passed away last year in January 2019, just a few months before the historical milestone where the index funds exceeded domestic, active mutual fund for the first time. But very interestingly, just before, 2 months before he died, he wrote this article in the Wall Street Journal. This is November 29, 2018. He wrote this article in Wall Street Journal, in fact, questioning the indexing, whether it's a good thing or not, or maybe there could be too much of a good thing. Can that be something negative in too much of a good thing? So he said, importantly, he said, the question we need to ask ourselves now is what happens if it becomes too successful for its own good? And he goes on to say that, this growth in index fund will create major issues for the coming era, that if the big three, meaning State Street, BlackRock, and Vanguard, hold about 30% of all listed equity. By the way, they right now hold about 15%, so we're halfway there. He said that I don't believe such a concentration will serve the national interest. So clearly these are strong words. And of course, he has mostly in mind this corporate governance issue. But I think that my talk today illustrated there might be something also, maybe another sort of darker side of this, which is that, again, this I pulled out literally this morning from CBOE, the VIX index, and we are reminded how volatile market can be. And I'm just wondering, what's different now? What's different now compared to 20 years ago is that a lot of this investment is now indexed. A lot more is indexed today. So these high level of market level volatility really begs the question where to hide, right? So that's sort of the main idea here that I wanted to share with everyone. And so, kind of what we're trying to say here is that it is possible. There is another dark side of a rise of indexing, which is a tremendously powerful innovation and very good things. Society-wide, it created a lot of value, but there might be some other consequences as well. In particular, it might defeat its own purpose of diversification because inadvertently it could change and increase the correlation structure between stocks and in fact lead to higher market aggregate level volatility. So of course, this is ongoing incomplete work. What I really want to say is that this area of research, I believe this indexing being the most disruptive, innovation in the financial industry in the last century really deserves the first order attention by us, by academics. And I look forward to seeing a lot more research on this, whether it's about information structures and incentives to collect information, or corporate governance, or something along the lines we've been investigating, which is about market volatility. I look forward to seeing more of this research and perhaps in future editions of this particular conference as well. Thank you.
Okay, thank you very much, Lily, for this keynote. So both informative and entertaining, which is a rare feat, and also setting part of the agenda for next year, like you said. So grateful for that.
Thanks.
And I may start the Q&A by referring back to one question from the Q&A panel. So, in your view, is there a risk that the strength of passive investing might be decaying as a result of the ever-increasing concentration of value and the somewhat homogeneous supercap tech stock components of the S&P, incidentally so-called Fang stocks? And
That's true.
right, so that would make making more difficult to truly diversify by following the index.
Yeah, I think that, that's a very interesting thing. I think one encouraging trend, though, is that, in the data, the indexing assets, so now, what's really good, the silver lining here is that indexing themselves are diversifying, right? So in a sense that you don't just, not everybody is jumping on the S&P 500 index anymore. There's been, especially the rise of ETFs, there's created many, many different flavors of this. And I think that that's actually going to be helpful to counter this concern that I have here, which is that, the increased correlation. And so you actually, in fact, the percentage share that's indexed through the S&P has steadily been decreasing in a sense, because you have, plural types of indexes that's indexing against different types of assets. And I think that that's actually going to be a good thing. But indeed, the other thing, which is about these very dominant firms and, and the Fang stocks, some, in fact, even just recent periods, if you look at the recovery since the COVID-19 low of March, right? We saw the indices numbers gone up, but that gain hasn't been shared equally at all. It's been mostly, gained by these large cap, super mega cap stocks, and the tech industry, certain industries has been sharing this, recovery rather than the rest of the economy. So indeed, anything that's leading to more concentration, whether it's at the firm level, some firms are more concentrated and showing up in many, many more indices, that will exacerbate the kind of concern that I have highlighted. But anything that kind of goes away from that, so like different kinds of indexing or indexing alternative assets and indexing other things, I think that would tend to counter that development. And one thing I see that is encouraging is that you have multitudes of indexing activities that's not just tracking the same thing by everybody, which is a good thing.
Okay, thank you very much. So Dion Bongards had a number of contributions to the Q&A channel. So Dion, if you would like to go back to your points yourself, I have just allowed you to talk. So you can unmute yourself, please.
Yeah, sure, thanks. Well, my most pressing point was kind of that this is uninformed price pressure, right? Which is transient. Mm-hmm. So one of the implications, if your story is true, is that you should see increased correlation when there's trades, but you should also increase correlation in price reversals because price pressure is transient. Mm. And that would also mean that as your frequency of observation declines, so if you go look at lower frequency observations, this effect should be less prevalent, and it should be more prevalent at daily observations, for example. Did you look at that?
Yeah, no. So you are absolutely right. I think that there are different frequencies, different things happening. So on the one hand, you have, I guess what we're trying to say, so in fact, I think that the 2 points are not contradictory at all, right? Exactly like you said, on the way up, if they're buying, and since it's transient, when you have reversals, that reversal can also become strong because of the correlated trading and basket trading. But that exactly is contributing to the overall volatility, right? The market level volatility. So in some sense, I think that you point a very, I don't think that these two things are kind of mutually exclusive or inconsistent with each other. I think that is precisely contributing to the overall market volatility. And maybe we can even identify this more sharply at a higher frequency because you can see the reversals of things. I think, but we haven't done that. And these things already at the frequency we look at daily returns, we don't look at intraday. But we do have a sense that lots of these intraday, very gyrations and things could be related. By the way, there was some recent Wall Street Journal article that said that during the COVID period, right, the ETFs trading was consisting of like more than 50% of the trading. And so possibly, is some of the intraday volatility also exacerbated by that? That's a great avenue to research. Even just at our daily frequency, it's a lot of data, huge scale, but this is a great idea. We should look into that. And but I think that exactly because, the run up and reversal can be stronger, it goes both ways, it would contribute to higher volatility overall. And there's a secular trend. So we're talking about both a higher frequency trend, but then secularly, I guess currently our study is more about the secular trend. But I think that the higher frequency evidence could further support and corroborate that secular trend.
But the low frequency would actually also, that it's less present at a lower frequency would actually also be an implication of the mechanism you have in mind, and therefore also a test of that mechanism. If you find a weaker effect at a lower frequency is actually good for your story.
Yes. Thank you for that.
And you could also try to get even more direct evidence by looking at order imbalance and trade volumes. Yeah, where there also correlation in that went up.
Yeah, I think it's a really rich area of research. I think we're just totally scratching the tip of the iceberg here, the top. So there's a lot more that we need to dig into for sure.
Okay, thanks.
Yeah, thank you.
All right. Thank you very much for this lively Q&A conclusion to the keynote session.